And now we're live at Jackson Hole.
Good afternoon. My palms are sweaty, knees weak, arms are shaky. Inflation's back up already, dollars confetti. I'm nervous, but on the surface, I look calm and ready. Before I take questions, I have some prepared comments to make about the market.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of green after Jerome Powell's Jackson Hole speech. He pretty much came out and declared we won. The fight against inflation is over. The Fed came out and said they don't have to wait until inflation gets to 2%. They're going to cut rates. He was very definitive. And now their view shifts to maximizing employment. Stocks rallied on the back of this, particularly stuff like real estate, technology, and just everything in general. But rate-sensitive stocks, GDP-sensitive stocks really outperformed. Real estate and discretionary up nearly 2% each on the back of just Jerome Powell's speech, as well as new home sales data. Home sales data came in better than expected, and that also lit a tailwind under real estate. We saw the S&P 500 was up 1.07%, a very bullish day across the board. The worst performing stocks were defensive stocks, XLV Healthcare, XLU Utilities, XLP Staples. Although still green for the day, this is exactly what you want to see in a risk-on environment. When it's risk-on, money is going to go into equities. These are still equities nonetheless. The companies that are growing earnings, but they were the worst performing sectors today, and that's exactly what you want to see. But what really outperformed was the Russell 2000, up 3.13%. Small caps were the biggest beneficiary of Jerome Powell's speech because they solely rely on the cost of capital, and the cheaper the cost of capital, the better they're going to perform. It's going to affect margins, growth, and everything in between, and that's why small value, core, and growth were up in excess of 3%, but mid caps also participated too. Across the size spectrum, they were up in excess of 2%, and even large caps, 1% for large value, 1.1% for core, and 1.2% for large growth. Large growth outperforming the broader market. Like I said, a lot of the defensive stocks are in this large value spectrum, and even globally, everything was bullish except for China and Australia. It was green action in Southeast Asia, Europe, South America, North America, Canada. It was just a green day across the globe. Markets really feeling the rate cut fever, and right now priced into the market here for September is 31 basis points worth of cuts, or 0.31%. I think the Fed's actually going to cut by 25. The market's expecting anywhere from 25 to 50, so sort of just splitting the difference. Another cut priced into November, actually 2.5 cuts. I think we'll probably get another 25 in November, and then December we have a full percentage point worth of cuts priced into the market. I personally think we're going to get 25 in each of these months, or 75 basis points worth of cuts into the end of the year, and I think the Fed are going to gradually cut into 2025. I think this is a bit much. I think we're probably going to get 100 basis points at a minimum. I don't think we're going to get 200 basis points into July 2026. That seems a little bit crazy to me. However, this is what the market is telling us. We don't predict, we react, and right now it's definitely looking like a September cut of at least 25 basis points, and then we're probably looking at another cut at least in November or December. Well, let's first get the September cut out the way. On the back of all of that, we saw yields fall across the curve. The 2-year yield was down 2.5%. Same with the 10-year yield, 1.5%. 30-year yield down 1%. Bonds gained as a result. The dollar actually fell, and that's why we saw gains across the board. Coupled with the dovish speak from Jerome Powell, when yields fall and the dollar falls, that helps smalls, that helps large, that helps mid caps. It's good for a risk-on environment. Bitcoin gained 5.47%. We also saw commodities gain. Gold was up 1.17%. Silver was up 2.94%. Commodities are a hedge against currency devaluation, and that's essentially what easier policy does. It injects liquidity into the system. Easier money, more money, cheaper money, and people hedge by buying commodities, buying Bitcoin. We also saw the S&P 500 up 1.15%, the Nasdaq 100 up 1.18%, the IWM was the best performing sector, up 3.19%, blitzing everything else. But the broader market gain, the RSP was up 1.21%, mid caps up 2%, the S&P 600 up 3%. Growth outperformed value, but it was risk on growth, and value did really well today. And we actually saw volatility fall 9% on the back of it rising into Jerome Powell's speech here. Just a bit of volatility. But let's actually dive into the S&P 500, and let's actually use the US 500, and we can see a couple of things. This is the daily chart. The advanced decline line made another all-time high right here. However, we did not make an all-time high in the S&P 500. This is bullish and often indicates the market's going to go and catch up to the advanced decline line and make new all-time highs. That's probably going to come next week in the S&P 500. But the week is over, and looking at the weekly candle, the market on this weekly candle right here looked really on shaky legs. Now this is looking very strong. 2 very bullish weeks in a row. The S&P 500 was up 1.39% this week and up 4.08% last week, and we're even bullish on the weekly advanced decline line. All-time highs, S&P not quite at all-time highs on the weekly, and that is insanely bullish. Looking at the weekly chart though, guys, it's just higher highs and higher lows, pretty much to all-time highs, and it does look like we're going to go ahead and get these highs. I would say probably into next week. The market's going to go and do that. The market wants to go and tackle one more all-time high before we go get into September. So the weekly chart looks bullish for the S&P 500. The daily chart looks bullish as well. And the S&P 500's gamma flip zone actually moved about 20 points up to the 5570 area. The put support and call resistance stayed at the 5700 area. So this is still very bullish, but we are seeing the S&P 500 trade very close to the gamma flip. So look, at any point we can just flip into negative gamma, and then we would trade as we would in negative gamma. But this looks very bullish. I wouldn't fight the trend both in the last couple of weeks as well as the year, but this is what the data is telling us. 5570 is the gamma flip, and that actually is a bullish thing. When the gamma flip moves up, it often means that the options market is expecting the S&P 500 to move up. I still remain convicted on the call resistance as our target. We're about 170 points away from that, from the 5700 area, and we're just a stone throws away from all-time highs in the S&P 500. Just a smidge over 0.5%. Things are looking very bullish. This chart looks like it wants to go take out all-time highs. Not even next week, literally on Monday. And then diving into the IWM, this looks very bullish. That is a bullish candle. We opened at the lows, made higher highs, higher lows, slight wick at the top, inconsequential. And in this run, we haven't even made a lower low. We've just made higher highs. The advanced decline line in the Russell 2000 at a new all-time high. And I think we're probably going to go tackle these 52-week highs in the next couple of weeks. Jerome Powell's speech was a real tailwind for small caps. And I think with the fact that small Russell 2000 earnings are coming in pretty good, not amazing, but coming in slightly above expectation, this is going to be a tailwind for small caps. And if we go ahead and take this 52-week high here at this 228, 229, maybe let's call it the 230 level. What's the exact number on that? 228.71. That is incrementally bullish and opens up new all-time highs. This is the weekly chart, and you can see when you do look at the weekly chart right now, this is the IWM's all-time highs right there. You can see higher low, higher low, higher low, higher low right here in the context of a 52-week high. All the market needs to do now is push next week and break these 52-week highs. If the Russell can do that, I mean, that's a huge tailwind for the Russell 2000. And I think small caps, mid caps are going to benefit the most over the next couple of months. When there's no recession heading into a cutting cycle, 12 months later, the Russell 2000 often returns anywhere from 15% at minimum plus. And you can see returns in excess of 50% in something like the IWM. But again, guys, I don't actually champion buying the IWM. I say buy the SP 600. And if you want more quality exposure, look at something like the CARF index. It wasn't up quite as much as the Russell 2000, but up 2.69%. And while the Russell is going to go take out 52-week highs, the CARF index is actually going to take out all-time highs. That's the difference between small cap quality and something like the Russell 2000. For those of you that bought the dip right here, when I said to buy the dip, congratulations. I think we're going to go higher. I think we're going to all-time highs. I think we're also going to get quite a bit of volatility in September, but that's September's problem. In the year and now, our target, the 5700. This is CNN's fear fear and greed index, very interesting to see. Guys, can you believe that just a week ago, it doesn't even show it here, but just a week ago, we were in extreme fear. We've pushed all the way into the fear zone, now slightly into the neutral zone. This obviously has to do with the ongoing breadth improvements as well as just markets rallying. Very good to see this, along with the AAI sentiment survey at about 50% bulls. Sentiment is moving in the right direction, and while something like the Nasdaq 100 is not necessarily showing it, underneath the hood the average stock is gaining. And looking at the overall fundamental picture of the market, earnings super robust right now on the revenue side as well as margins. Look at earnings, 12.5% growth here for the second quarter. Estimates at the start of earnings season were 11.1%. Very similar situation for the revenue side, 5.4 versus 4.6%. That's really good, especially on the revenue side. And then margins, probably the biggest story of this earnings season. Expectations were 11.8, they ticked up to 12.2%. 463 companies have reported in the S&P 500, and earnings actually look a lot better if you exclude energy. Now, where does that actually leave us with valuation? Currently, the S&P 500 trades at a 21.4 times PE. You can see all of the sectors right here, a PEG of 1.3 and a free cash flow yield of 3.3%. I would say that everything here looks a little bit pricey in my opinion, but you can definitely find value in other sectors. Stuff like comm services, healthcare, they're trading at a 1.1, 0.9 PE, a 4.9, 3.3% free cash flow yield, and a PE of 18 and 19 times. Great value in these sectors right here. The most expensive sector is technology, and the least expensive sector where you're going to find the most value is energy and financials. Now let's switch gears and actually talk about the retracement we actually saw here in the S&P 500 over the last couple of weeks. We actually pulled back about 10% within just a couple of weeks, pretty much parred all of the losses we saw here in the S&P 500. And here's some interesting data from Warren Pies. He says that when stocks pull back greater than 5% and recover to new highs within a short period, there's virtually no cases of a subsequent 10% drawdown over the next quarter. You can also see that regarding corrections, 76% all play out within a 60-day window, and that's why when you get these sharp snapbacks in the market, you need to buy the dip quite aggressively. That's why I have a general rule of thumb: you want to load up big every 10% pullback, because you don't know how much further the markets are going to go. No one has a crystal ball, especially when the markets are incredibly volatile, and that's why you need to have a plan in place, a dollar cost average plan, as well as a buyback plan when the market does give you these opportunities, because sometimes they're only worth a couple of days, and those corrections often don't give you a second opportunity to get in. So when the S&P 500 pulls back greater than 4% and then rallies to within this number of its highs, what percentage of the time does it actually go back to make a full correction or a 10% decline? And in this instance right here, it only happens 10% of the time. So you can see right here that when we have a pullback greater than 4%, we normally go make a 10% correction about 39% of the time, 22% of the time in this period, and then only 10% of the time if we get to within 2 to 3% of all-time highs. And guys, that is why I always say you want to buy the dip, because corrections happen quick and they happen violently. However, if you did miss the most recent correction in the S&P 500, luck may be on your side. Looking at election year seasonality, we are literally going from the best 3 months in an election cycle to the worst 2 months, September and October, which often have negative returns. They can be very volatile and the hit rates are rather poor. But again, you want to buy the dip, not just because of the data I showed you, but because seasonally, November and December tend to pair all of those gains and then some heading into November and December, and oftentimes that rally continues into January and February. And while the markets might look overvalued, only 50% of signals are triggered today versus an average of 70% in prior market peaks. So there's still room to run. The market hasn't topped out just yet. We would need at least 70% of these to trigger before we actually go ahead and market top. And guys, let's look at some macro analysis. This is US rail traffic for this week here in August August 17, and we have seen a huge jump in US rail traffic, perpetuated by a huge increase here in grain supplies, petroleum products, other, as well as a decrease in coal. Total intermodal units up 14.3% versus 2023. Total traffic up 8%. Just for the record, rail traffic actually tracks GDP very, very closely. And look at these year-to-date components versus 2023, up 8.9% and 2.7%. Those changes came from a huge jump in grain supplies, petroleum products, weakened by a decrease in coal, obviously, but then you look at it at the same time last year, significantly less, a deceleration in the decline. And the massive jump we're seeing speaks to the seasonally and strong industrial bump late in the third and fourth quarter upcoming. And with the consumer hanging in there, retail sales remaining strong, this is actually going to be a tailwind for the economy in the third and fourth quarter that's probably not priced in yet, and that not a lot of people know. And if the economy is slowing, it hasn't really shown itself in rail traffic just yet. But a big concern in the market actually had to do with the overall revisions we saw in the BLS earlier this week. We saw total private and non-farm revisions about 818,000, but the market wasn't really shocked. And here's a note from Goldman telling us why. They said the BLS preliminary benchmark estimate for the revision to payroll growth between April 23 and March 24 is negative 818,000 or 68,000 jobs a month, in line with our expectation of 600,000 to 1 million downward revisions. As we have noted last week, we think that today's downward revision to payroll growth exaggerates the degree to which job growth has been overstated by about 500,000, both because the QCEW likely excludes many unauthorized immigrants who are not in the unemployment insurance system but were correctly picked up in payrolls initially, and because the QCEW itself has tended to be revised up in recent years. As a result, we think the true downward revision should be about 300k or 25,000 per month, which would imply that monthly job growth over this period was closer to 250 to 220k than the initially reported 242k, but not as low as the 174k pace implied by the revisions. And this is why the market didn't freak out, because this is still a very good number given the macro picture. Now, diving into Jackson Hole and Fed funds, this is very interesting data that I'm going to relate to the market, right? This is 2019 to 2024, and it's literally the Fed funds as well as core PCE at the time of Jerome Powell's speech at Jackson Hole, and then the real rate of interest. So essentially, you take the Fed funds minus the PCE, you get the real interest rate, right? So here in 2019, the actual real interest rate on the debt you were paying was 0.57%. Really good, actually. You can see it in 2020, 21, 22, when the Fed literally cut rates a lot and we still had moderate inflation. The real rate of interest was negative 0.66. Then in 2021-22, negative 3.76% and negative 2.46%, simply because inflation was actually higher than the Fed funds rate. Right here, Fed funds are way too easy. This is what we were in 2023, just last year. 5.5% Fed funds, 4.28% PCE, and that is why we actually had to increase the Fed funds from 2.5 to 5.5%, or 0.25 to 2.5 to 5.5, because inflation was really stubborn, and that's why we had a real rate last year, 1.22%. This is kind of what the Fed wants, anywhere from 0 to 1%. Here in 2024, as of Jackson Hole, a 5.5% Fed funds, 2.63% core PCE. That means the real cost of capital is 2.87%. And this right here is too tight. That is why the Fed wants to cut rates. And eventually, this figure right here will have a major impact on the economy if left too high for too long. Now, looking at S&P 500 returns, when the Fed funds rate has been too high, you can see in 2023 as well as 2019. And then we look at 2020 as well, right? When the real cost of capital was fairly tight, relatively speaking, to this data set, we saw outsized returns, right, in the S&P 500 12 months later of 16%, 28%, and 28% respectively in 2019, 2020, 2023. But when the real interest rates were way too easy, we actually saw subpar returns, -9%, -5% in 2021, 2022. And that's just because of market dynamics. Right now, the real interest rate is 2.87%. The Fed are going into a cutting cycle in September to lower this rate, which is going to be supportive for the economy and really good for stocks. And this is what history tells us. And while history doesn't repeat itself, it sure does rhyme. And then looking at the week ahead, guys, we actually have a very interesting week of earnings. Now, we don't have too much on Monday. We have PDD and Trip.com as well as Heiko. And things really kick off on Tuesday with Scotiabank and Sentinel-1. Then we really get going on Wednesday with Abercrombie Fitch before the open, as well as Chewy, Foot Locker, Bath Body and Works, as well as RBC. Then after the close, we get the big one: Nvidia, CrowdStrike, Salesforce, Affirm, Okta, Viva, HP, NetApp. A big day for software, tech, semiconductors. Then Thursday, we have Best Buy, Dollar General, American Outfitters, Campbell's. So a lot of consumer stocks reporting here before the open, discretionary and staples. And we also have Ulta Beauty, Lululemon, Dell, Autodesk, MongoDB here on Thursday. So Wednesday, Thursday, as well as Tuesday is going to be big for cyber, tech, as well as the consumer, and then not much happening here on Friday. So a big week of earnings and also a big week of data. We have durable goods orders here on Monday. Then Tuesday, we get consumer confidence as well as the housing price index. Then Wednesday, we have a tame day. Fed Bostic is speaking, but we already got all we needed with Fed today. Then Thursday, we actually get PCE, the Fed's preferred gauge of inflation. And while inflation is behind us, yes, we still have to pay attention to the movements in inflation because it really can move the market. Then we also get the GDP second quarter preliminary revisions, initial jobless claims, and pending home sales. And then on Friday, we get the price index for PCE, core PCE, Chicago Purchase Managers Index, the PMIs, Michigan sentiment, and then inflation expectations, as well as income outlays, personal income, personal spending. So a huge week of data. We're going to tackle each of these days as they come. And on Monday, the consensus for durable goods is 4%, and then ex-transport, we're looking at 0%. So that's what you got to pay attention to on Monday. But I think things really ramp up here on Thursday. We have a heavy week of data, coupled with the fact that we also get Nvidia, CrowdStrike, and some of these bigger names reporting earnings here in the back end of the week. So a back end loaded week, that's how we like it. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell. Guys, hit the like button and leave a comment for the algorithm. Cheers.